It is true that central banks are buying more gold. You're absolutely right about that. And by the way, gold is having a nice bounce back. It's kind of rallying here. You're right about that, but it kind of got smashed from around 5,400 down to 4,700 in a matter of a week or so. What was that all about? Again, that wasn't I hate gold. That was people sold gold because they needed cash. The price of gold is going up, and the percentage of global reserves in gold is going up. It's what saved Russia during the Ukraine war. We froze, 300 billion of their treasury securities, but Vera Nabiullina, who's the head of the central bank of Russia, had put 25% of the reserves in physical gold. We couldn't freeze that.
In light of this conflict, where do you see gold ending this year?
$10,000 is still a realistic estimate. I said some time ago it was 5. It got to 5. It got smashed down a little bit. It's kind of working its way back to 5,000 in stages. But yeah, it'll go along with the kind of inflation that we talked about, and the things we talked about earlier in the segment, Michelle. Central bank demand is not going away. Supply is flat. Central bank demand is going up. The safe haven asset attractiveness of it is going up. To the extent people do want to, I sort of poured cold water on the de-dollarization thesis, but the idea that central banks are moving from dollars to gold, that's true. That's very well documented. So that will continue to drive it. And then I did the very simple bit of math where I pointed out that if you use $1,000 increment as a marker, each $1,000 increment is easier than the one before because you're working off a higher base, so it's a smaller percentage gain. So going from $4,000 to $5,000 an ounce is a 25% increase. That's a heavy lift. But going from 9,000 to 10,000 is only an 11% increase. That's much easier. So you kind of struggle. I don't know if it's the right word. You kind of struggle, or it'll take time to get to 6 or 7, but you're going to go 8, 9, 10 really quickly.
Mainstream analysts were shocked when gold shattered its all-time highs, but macroeconomic expert Jim Rickards warns the rally has barely started. Driven by massive, relentless central bank accumulation and a mathematically flat physical supply, the ultimate target is $10,000 an ounce.
Okay, so that still is on target. And just to be clear here, you do not see this conflict as significantly altering the global monetary system.
I see problems in the global monetary system with or without the conflict. So I'm not sanguine about it. I think there's a lot of trouble in the global monetary system. The private credit meltdown, the central banks going to gold instead of dollars, a global dollar shortage because the banks are pulling in their horns. All of those are problems. The Iran war is kind of an overlay on that. So I think it makes it worse. I would say we have a global monetary problem anyway, but the war makes it worse because of the increase, not just the increase in the price of oil, but the supply. The U.S. is not going to run out of oil. We got plenty, but the rest of the world, South Korea, Japan, China, others, they're going to see supply shortages. They already are. It is true that central banks are buying more gold. You're absolutely right about that, and I think you framed it exactly right. The contest is the dollar and gold. It's not the dollar right now. The euro is about $1.16. You know what the euro was when it was launched in 2000? It was $1.16. In other words, 25 years later, the euro-dollar exchange rate is exactly where it is. Now, it's bounced around. It was up to $1.60. It was down to 80 cents. It was like a great time to vacation in Europe. I understand that there's volatility. You can make or lose money trading. It's right where it was 25 years ago. There's no de-dollarization in the currency markets. Gold is different, and I agree with you completely. But what's going on with the dollar is not de-dollarization, except central banks are buying more gold. When central banks are selling treasuries, which they are, there's the Treasury has a monthly report on international currency holdings. It's a spreadsheet and it shows all the countries and how much they own in treasuries. Countries are selling treasuries, but they're not dumping them to get out of them. They wish they had more. They're selling them because they need dollars. Again, a security is not a currency. It's denominated in a currency. A U.S. Treasury security is denominated in dollars, but it's not a dollar. If you need dollars, you got to sell the Treasury, get the dollars. What are they doing with the dollars? They're propping up their own currencies, and they're propping up their banks, and they're dealing with credit crises, whether it's real estate in China or a private credit in the United States. So there's actually a global dollar shortage and the beginnings of a global dollar liquidity crisis. And the reason people are selling treasuries is not because they hate treasuries. It's because they need the dollars to prop up their banking system and pay off bad debts. And this is symptomatic of this liquidity crisis. So we're not looking at de-dollarization versus other currencies. We are looking at increases in gold. You're absolutely right about that. But the bigger play is there's a global dollar shortage. We may be walking into a buzzsaw in terms of a global liquidity crisis. And by the way, Michelle, that has been happening for a while. That's been playing out for a couple of years. If there were no war in Iran and we were doing this interview, we'd be talking about that as a separate problem. The fact that you've got a dollar liquidity crisis, a private credit meltdown, and a war in Iran all at the same time is extremely concerning, and we could be looking at best, a recession and perhaps something much worse. What I think a lot of people don't understand in terms of the Strait of Hormuz. The Strait of Hormuz was closed almost the day the war began. I think it was February 22nd. I mean, check me on the exact day, but it was around the end of February. But there was a lot of oil and natural gas and fertilizer, for that matter, in transit that was already outside the Straits of Hormuz. It was unaffected by the closure of the Strait of Hormuz. Now, that can take 2 or 3 weeks to get to South Korea and Japan and India and the ultimate users, and perhaps even longer, as I say in the case of South Korea. So the ships were underway. They were still delivering. The stockpiles were still there. There was nothing about closing the Straits of Hormuz that affected the supply immediately because it was already on the way. But now we're 7 weeks into this. Now the supply has dried up. There are no tankers underway. And it's really just now, as we speak, that the shortage is going to kick in.
The global energy market is currently sitting on a powder keg. Mainstream financial media is completely fixated on the daily price of oil. Retail traders are entirely missing the bigger picture. The true threat to the global economy isn't just localized conflict, it is the catastrophic vulnerability of the world's most critical shipping choke points, which hold the entire Eastern Hemisphere hostage.
In terms of the stock market, for example, the idea that the stock market is an efficient information machine and discounter of future news is nonsense. That's like AKA Eugene Fama. They all won Nobel Prizes for things that are nonsense. Stock markets are very inefficient. They run on emotion. They don't adjust gradually. They gap up, they gap down, there's volatility, etc. So right now, my view of the stock market is that stock markets, and to some extent bond markets, have not discounted what we're talking about. There's the narrative that Wall Street's on and what the market is what it is. I mean, you can't really fight the market in that sense, but there's that based on a narrative, and then there's the reality. Reality always wins, but it can take time. So how many analysts on Wall Street have you heard saying, well, we think the war will be over in 2 to 3 weeks. The war will be over in 2 to 3 weeks. But they've been saying that for 9 weeks. I mean, that's my point. It's like, how many times do you say 2 to 3 weeks and the 3 weeks go by and you're still fighting when you're like, oh, you know what? Maybe this is going to last for years. Maybe this damage is going to take 6 months to a year to repair. Maybe when you start shutting down refineries, it's not like throwing a switch. You can't turn them on just because the oil shows up. The amount of what you have to do to get that, to prepare that kind of infrastructure to be used again after it's been shut down is enormous. And so that's already baked in the pie. Like I say, even if peace broke out tomorrow, which I don't expect, the damage has already been done. And the markets haven't reflected that yet. Yeah, Fed money printing is so-called is kind of irrelevant. The Fed's mostly irrelevant to everything we're talking about. I'll kind of spend a minute on how the Fed creates money, and they do create money. You're right about that. So how does the Fed create money? How do they print money? Well, what they do is they have an open market trading desk in New York, and they call up the primary dealers. That's Goldman Sachs and Morgan Stanley and Citi and JP Morgan and all the big banks. And they say, offer me 5-year notes. And the trading desk offers them 5-year notes. Done. The bank sends the 5-year notes to the Fed, and the Fed sends money to I'll say Goldman Sachs or Morgan Stanley, and that money does come out of thin air. So that's true. But then the question is, what does the bank do with the money? The bank that just sold the Fed the securities, what do they do with the money? They give it back to the Fed. in the form of excess reserves. The Fed's a bank, and you can have an account there if you're a member of the Federal Reserve System. Money doesn't go anywhere. It doesn't get lent. It doesn't get spent. It's not stimulating. It actually doesn't cause inflation. It just sits there. It's sterilized on the Fed's balance sheet. Okay. Where does the money come from that does do the things you're raising, that does cause inflation, that does, help the economy or contract the economy? That money comes from the commercial banks. It comes from JP Morgan, the Citi, and, Bank of America and Wells Fargo and all the rest. What are they doing? They can print money too, by the way. People don't understand that. If I go to a bank and take out a loan, and they put, okay, I sign a note and say, okay, Jim, here's your loan, and they put the money in my account. Where's that money come from? It's ledger money. It comes from thin air. In other words, the banks can create money the same as the Fed, but in that case, I probably borrow the money for a reason, and I'll probably go invest it or spend it or run a business, do something with it. That's the money that counts. So what are the commercial banks doing in that vein? Well, they're doing the opposite of what you suggest. They're tightening credit. They're concerned. They're going to have write-downs from the private credit crisis. They're going to have customers to go bankrupt because of the higher price of oil. Or the higher price of oil is going to cause people to spend more money at the pump, which means they'll spend less money at the grocery store or entertainment or vacations or clothes or new cars or whatever else it is. That part of the economy, again, where the money actually comes from, that's in retreat. So the Fed is mostly irrelevant. Fed money printing, it does exist, but it doesn't matter because it all stays on the balance sheet. You have to look at the commercial banks, and they're pulling in their horns. The dollar will remain the leading currency denomination. Again, it's the denomination that people don't have $100. Yeah. Well, the unit of exchange is not the reserve currency. People don't have stacks of dollars in the basement of the central banks. What they have are treasury securities. And no, I don't see that being rejected, but they are selling treasuries to get cash, which is a different issue. But gold is going up. I mean, the price of gold is going up, and the percentage of global reserves in gold is going up. It's what saved Russia during the Ukraine war. We froze, 300 billion of their treasury securities, but Vera Nabiullina, who's the head of the Central Bank of Russia, had put 25% of the reserves in physical gold. We couldn't freeze that. And in fact, when the price of gold started going up from $2,000 to $5,000 an ounce, Russia made as much mark to market on the price of gold as they lost on the frozen treasury. So that was a pretty smart move by her.
Sovereign nations have completely lost trust in the Western financial system. After the United States illegally froze hundreds of billions in Russian treasury assets, global superpowers immediately realized that physical gold is the only reserve asset on Earth that cannot be confiscated or sanctioned.